Hi, my name is Darren Joseph from HEJ.tax. We're the team that seeks to demystify the sometimes confusing world of international taxation. And today we have the honor and the privilege of speaking with Mr. Ron Murphy. Ron, would you like to introduce yourself, please?
My name is Ron Murphy. As you might tell from my accent, I'm actually Irish. I come from a private banking background in Ireland, and I've been working with the expat community here since 2012. I'm a financial planning manager with Épargne Salariale. What we try to help our customers basically in terms of growing wealth, whether it be via liquidities, whether it be optimizing taxation, and we also deal an awful lot with cross-border issues. We've been around since 2008, so we're based in the southwest of France in Toulouse. We cover all of France. Then something else that I mentioned in relation to, which is extremely common, especially here down in the southwest, with Airbus being such a prominent employer, and that there are Americans that do work for companies down here, large companies. They can benefit from what's called Épargne Salariale. So the Épargne Salariale, basically, it's a way for companies to pay employees, but it's beneficial to the employer because there's less charges involved. And it's also beneficial to the employee because there's also tax advantages that are linked to them. There are several different types, but for instance, there's the PE, or depending on the size of the company, it could be PEI or PEG. And basically, that is funds that are blocked for 5 years, and they are tax free at the end of it. At the end of the 5 years. But what's also interesting is that there can be what's called an abonnement from the employer, which basically means that they can, for what you contributed, they can contribute anything between 0 and 300% to your payroll. So it can be very interesting. Then you also have the PERCOI, which is again blocked until retirement. But again, you can have also an abonnement from the employer, and it's the same rule because it's the retirement vehicle. What you put in can be deducted from your taxable income, but if you do so, you will be taxed on withdrawal. Before, that wasn't the case. Before, it was completely tax-free, but under the new ruling, that is the case now. There are limits to the amount that you can actually put in. So for the payroll, it increases every year, but it's roughly around 5,000, slightly over 5,000 euros. And for the PERCO, it's slightly over 6,000 euros. So it's very interesting and very beneficial for the employees. But it's something, I suppose, because it is PFIC, passive foreign investment company ruling, they need to be very careful how it's actually invested, because you definitely can put it into a monetary fund, but I suspect if they're invested it via shares, it's going to, because that you have a liability in the States.
Absolutely. And again, just to rehash the PFIC regime, passive foreign investment company, this is under Section 1297 of the U.S. tax code. And to understand the intent of the law, I think is helpful. So it dates back to the 1980s under President Reagan, when U.S. domestic financial institutions were complaining that U.S. taxpayers had an incentive to invest in foreign mutual funds or foreign investment structures because they got tax benefits abroad that outweigh what they were getting domestically. So typically you put it outside and you're not going to pay any taxes until distribution. And that is way more attractive than that was typically available within the US, and it was unfair. So what the government did is they created this PFIC regime that not just sought to level the playing field, but in a way was a bit punitive. So in some ways you can view it as punishing that US taxpayer that is investing in what is essentially a foreign mutual fund or some sort of self-directed investment structure. So, and again, what you're looking at is where 75% or more of the gross income is passive, like interest, dividends, capital gains, and stuff like that, or 50% of the assets held in the structure for production of this passive income. So yeah, I mean, there are a number of ways of treating it. I mean, there is the QAF election, there's the mark-to-market, and there's the default. But either way, you don't get that tax deferral, which I guess is the holy grail for any investor, really, for money to compound on its own without having to pay taxes along the way. You don't get that. But there are ways to minimize the pain and avoid that default, which is where you're going to be taxed on the excess distribution. And there's some nasty throwback rules. So you can look at, depending on what investment you're looking at, you can look at mark to market, or depending on the way the reporting is done, you can make a QEF election of a qualified election fund. That way, the income retains its character on the U.S. returns. So it's not all taxes, ordinary income. So you can get capital gains, which in the U.S. tax code is way preferable to ordinary income. It could be as much as half of the burden of ordinary income. So there are ways of treating it, but the point is that if left untouched, it's going to be very painful. It's going to be really messy, and there is no tax deferral, unfortunately. Generally speaking, there's some little exceptions, but generally speaking, that tax deferred growth that is attractive under the French tax code is definitely not available under the US tax code.
Okay. And is it a fixed rate tax in the States for this? Does it vary?
It varies. So depending on the election someone takes, if it's taxed at the ordinary tax rate, it depends on where you are in the ladder, right? So you need to look at whatever, not just the income that arises from that structure, but all of your income. So from your wages, your salaries, your bonuses and stuff like that. So it may push you up to the highest marginal tax rate, which right now is around 37%, which is highest for the higher income earners.
So if all your revenue is based in France, do they actually take that revenue into consideration, or is it only US based revenue that they would take into consideration?
That's an unfortunate thing that makes the US a bit different. You're taxing your worldwide income regardless of where you reside. So they pay, generally speaking, there's little attention paid to the fact that you're living in Paris versus Pittsburgh or Marseille versus Miami.
Yeah. Okay. So it potentially could go up as far as 37%. Okay.